So very good evening, guys. This side Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting, and also a venture capitalist. As we speak, on 11th January 2021, I would like to be covering a very important topic, which is RBI neutral repo rate and the impact on the sovereign curve. But before that, let me remind you that in any other YouTube video, our YouTube video also having a dialog box. So you can see, I would say, all our free groups on the dialog box. Apart from that, we have our news group, video training, Sheetal Academy, FNO Learnings Academy, and so many things which you can look at, you can look at, or you can WhatsApp at 9818485155. 9818485155. We understand that every central bank of the globe, having a overnight rate. I don't know why we don't call this as an overnight rate in India, and why India is having so many rates like repo rate, reverse repo rate, and all. In case of India, we have repo rate. Basically, it is a rate at which RBI lends to commercial banks, and one is reverse repo rate. One is known as interest rate parity. I don't know how many people know this or not. Repo minus reverse repo is known as interest rate parity. One is known as MSF, which is marginal standing facility, which is known as what? Any guess? Which is known as what? Any guess? Okay, let me leave for you. Let me leave the formula to you. MSF. You tell me the formula. What is the formula for MSF? Winner will get a super prize if you tell me the formula. And then we have, which is known as call rates. And here mutual funds, some foreign banks, Indian banks, they play like a cricket match. Sometimes foreign banks win, sometimes Indian bank wins. Anyways. And then India is having a sovereign curve also. On paper they call this as sovereign curve, but how till what extent it's a sovereign curve, you guys just look at that. This is actually the sovereign curve of India. Now as you see that this section where my mouse is, this is 11th January 2021, right? You can clearly see that this is 11th January 2021. This is the tenor. 3 months, 6 months, 1 year, 2 year, and like this. This is 40 year. Previously, the maximum bond issued by India was 30 years, but very recently it is 40 years. This is issued in 2020, to be honest. You can see that the maturity date is 15 December 2060. 40 years, and the coupon they are offering just 6.8%. This is the bid, this is the ask, and most important thing to me is this swap spread. I know that 99% of the people do not know what exactly is swap spread and what is asset swaps this is. And neither these things coming in public domain. Forget the Z spread. Let me have another question to the people, those who are doing CFA, CR, and all these questions before I continue. Let us take this 10-year curve. Okay, now let me write, I am taking a 10-year bond where the coupon is how much? 5.77%. Okay, and swap spread is this. You can see around 37.6 bips In our case, we call this as swap spread 37.6 bips. Many intelligent people of the globe feel that swap spread can only be positive. Excuse me, swap spread can be negative also. And it can be zero also, for your information. Right? Then we have asset swap spread. We call this as asset swap. So let me take asset swap as how much it is? Around 21.7 bips. Intelligent people feel that this is also plus, but they do not know that this is plus, this is zero, and this is minus also. And then we have Z spread, my favorite, around 23 bips. Let me take precise so that no one comes to me that you have not taken precise. This is once again plus minus 0. Now the bid yield is equals to what? Around 5.924. And let me take the ask yield 5.917, this one. Hey guys, tell me, let me check your knowledge. What would be the swap spread yield? Tell me. What would be asset swap yield? And tell me how much would be Z spread yield. Tell me. Let me see how much you know also. And this is what I'm showing to you once again for 2 minutes. You can clearly have a look. This is what from Thomson Reuters. You know, we people feel that what we have in the books is always right, but most of the things you do not have in the books. Take a screenshot of this and let me know how much you knew this about. Let me see how many people will answer me. Now let me answer. Now what happened that when this 2020 pandemic happens, majority of the central bank cut their overnight rate like this. In case of European bank, the situation is like this. India is still here. The cut in the overnight rate needs to be substantiated in the sovereign curve. So overnight rate plus transmission mechanism is equals to sovereign curve. First of all, India do not have a sovereign curve. It is the biggest myth that India 10-year curve is a sovereign curve. Officially, India do not have a sovereign curve. So even if RBI cut the rate or increase the rate, it will never translate 100% into the via this transmission. So never end up as a sovereign curve. So practically there are two kind of repo rates. Now one kind of repo rate is the normal repo rate at which RBI lends to central banks, and one is known as, which is most important to me, which is known as neutral repo rate. I term this as NRR. I know that our Hindi media, English media, they will never discuss about this because they themselves do not know what exactly is this. Now, what is neutral repo rate? I will show this via a chart. Neutral repo rate is the rate at which the monetary policy of that central bank is neither accommodative nor hawkish. Well, forget hawkish. Hawkish is impossible probably in this decade. To be honest, the way coronavirus is shaping up across the globe, let it be honest. Accommodative means this. Cut, cut, cut. Hawkish means this. Up, up, up. The most important thing for any central bank of the globe is to maintain neutral overnight rate. Now, in India, we call this as neutral repo rate. Maybe across the globe, like US and all, we have different names. We have, like, speak in terms of US, we have neutral overnight rate. Now, what is neutral overnight rate? Let me show this to you. Now, neutral overnight rate is that. How to compute the neutral overnight rate in terms of US parlance? They will take the 10-year USD. USD stands for United States Treasury. Now, 10-year USD, assuming it is trading at 1%. Why assume it is trading at 1%, to be honest? Now, they will see the minimum, assuming they are taking a period of 10 years. In the last 10 years is around 0.40%. Okay. The maximum in the last 10 years is around 1.25%. It means we are in between. Now they will create a barrier. Now what is that barrier is all about? They will say that our barrier is 1.10%. It means that the 10-year USD should not leave 1.10. How central banks manage this? They have a variety of tools to manage this. And one of the favorite tools is sterilization. Sterilization is actually divided into two parts. One is known as gross sterilization and one is known as net sterilization. It depends how different central banks go, but generally people prefer gross. They don't prefer net. But to be honest, gross and net both are having their own permutations and combination. Sterilization cannot achieve until these two departments of a central banks are in sync. One is fixed income and one is FX desk. Both supposed to be in sync for sterilization. Okay, so I'm not explaining the complete sterilization in this video. Now, how the neutral overnight rate is achieved is like this. Neutral overnight rate is achieved keeping the following factors in mind. Number one, how much is the balance sheet of the bank? Like in case of Federal Reserve, the current is, if I'm not wrong, I don't have precise number, but according to the public sources, it is this, which is by the way a huge amount. How much maximum they can afford? Now here I am taking a guess, 8 trillion. Here also there are two opinion, gross or net. I am taking gross. Let me write so that, okay, it is gross. Second important thing is that sovereign curve barrier, assuming it is 1.10%, you know, and most important thing is GDP. How much is the GDP growth last quarter of the US is around 33%. Now, how exactly they manages this? And let's have overnight rate, which is current today. Which is around 0.25%. Now, what does that mean, guys? It clearly means that if GDP, let me make a chart. Due to any reason, coronavirus and not, if GDP, which is currently here around 33%, even if it goes to here, which is say minus 33%, the maximum cut in the repo rate or the overnight rate would be say by say 15 bips. So we will take this to, we will revise this to 0.10%. If we revise this to 0.10%, we need to revise in such a way that sovereign yield curve barrier should not cross. Number one, very important. The balance sheet size should not cross 8 trillion. Henceforth, it is said that the neutral overnight rate or neutral repo rate, whatever you say, is a rate at which the policy is neither accommodative nor hawkish. But the point is, this can only possible provided you have a sovereign yield curve. Example, let's move back to the sovereign yield curve. Guys, just have a simple thinking. You have 3 months, 6 months, 9 months T-bills are not there. 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7 year, 8 year, 9 year, 10 year. That is okay. You know, look at this: 11, 12, 13, 14, 15, 16, 17, 18, not there. 19, 20, 21, 23, not there. 24 to 30, rest missing. 30 to 40, rest missing. What does that mean? Do you understand that? Now I'll tell you what does that mean. This means that any sovereign curve of the globe, is divided into 3 parts. Number one is which is known as treasury bills, which is 0 to 1 years. Number two is treasury notes, which is 1 to 10 years. Here India is okay. Here India is more or less okay. One is known as treasury bonds. Now here it is 10 years till even 100 years. Guys, the biggest mistake we have in the sovereign curve is that number one, officially 10-year curve is not a sovereign curve. Number two, 10, 11, 12 till 40. Allocation should be everywhere. There are many places where allocation is not there, and this is the reason why transmission mechanism is leaking. And this is again one of the reason is that the neutral rate cannot be come out. Example, just check this out, guys. 10-year yield is around 5.9%. Am I correct? 40 years yield around 6.5%. Okay, which means what? 60 bips difference. Tell me, would you be holding your money for 30 more years? 10 versus 40. If you would you be holding your money for 30 more years only for 60 bips? Only for 60 bips. Just let me know. See this another mistake. Example this. From 30 years yield is 6.5. 40 year is 6.5, which is more or less flat. 24 years is again 6.5. 19, 24, 30 and 40. 19, 24, 30 and 40. How much would you be, what is the risk premium? The risk premium is 0. Risk premium is 0, Z-E-R-O. These are the major inefficiencies which we have in the benchmark curve. But before I go ahead, let me tell you another big this. If now there are two curves which we have, let me tell you. Now this is the, let me tell you, the long dated curve. It looks like that long dated curve is like this, which is flat, and it looks like that the premium is also flat. And do you know how this curve should be? The ideal position of this curve should be like this. And this means risk premium. Thank you guys. This is Rahul from Treasury Consulting. You know our WhatsApp +91 9818485155. Have a great time ahead and talk soon, guys. Thank you.